Welcome! In this video, we'll break down everything you need to know about the new IRS rules for deducting car loan interest under the One Big Beautiful Bill. If you've recently financed a new vehicle or are considering it, you'll want to understand how this deduction works, who qualifies, and how much you can save on your taxes. We'll walk through eligibility, calculation methods, and the step-by-step process to claim your deduction. Whether you're a first-time car buyer or a seasoned taxpayer, this guide will help you maximize your benefits and avoid common pitfalls. Let's get started by exploring what the car loan interest deduction actually is and why it matters for your tax return. The car loan interest deduction is a federal tax benefit that lets you deduct up to $10,000 of interest paid on a qualifying car loan each year. This deduction was introduced as part of the One Big Beautiful Bill and is available for tax years 2025 through 2028. Unlike some other deductions, you can claim this one even if you don't itemize your deductions. The goal is to make car ownership more affordable for Americans, especially those purchasing new vehicles. In this scene, we'll clarify the basics of the deduction and set the stage for understanding who can take advantage of it. Not everyone can claim the car loan interest deduction. To qualify, you must have purchased a new vehicle with a loan taken out after 2024. The vehicle must be assembled in the United States, have a gross vehicle weight rating under 14,000 pounds, and be driven primarily for personal use. There are also income limits. The deduction begins to phase out if your modified adjusted gross income MAGI is over $100,000 for single filers or $200,000 for married couples filing jointly. Understanding these requirements is crucial before you plan on claiming the deduction. Let's take a closer look at which vehicles qualify. Eligible vehicles include new cars, minivans, SUVs, pickup trucks, and motorcycles, as long as they're under 14,000 pounds and assembled in the US. Used cars, even if they're new to you, do not qualify. The vehicle must also be built primarily for use on public roads. This means off-road vehicles, golf carts, and similar types are excluded. Make sure to check the vehicle's window sticker or use the VIN decoder on the National Highway Traffic Safety Administration's website to confirm the assembly location. To claim the deduction, your new vehicle must be used primarily for personal reasons. At the time you take out the loan, you should expect to use the car for personal or family purposes more than 50% of the time. If you use the vehicle for both business and personal reasons, you may still qualify, but only the personal use portion of the interest is deductible under this rule. If your plans change after purchase, you can still claim the deduction as long as your original intent met the personal use requirement. If you use your vehicle for both business and personal purposes, you may be able to deduct some interest as a business expense on forms like Schedule C, E, or F. However, you cannot double dip. Any interest deducted as a business expense cannot also be claimed as part of the car loan interest deduction. It's important to keep clear records and allocate your interest payments accurately between business and personal use to avoid IRS issues. To confirm your vehicle was assembled in the US, check the window sticker at the dealership or use the VIN decoder tool provided by the National Highway Traffic Safety Administration. The assembly location is critical for eligibility. Even if some parts are made elsewhere, the final assembly must occur in the United States. This requirement helps support domestic manufacturing and ensures only qualifying vehicles are eligible for the deduction. Not all car loans qualify for the deduction. The loan must be taken out after 2024, used to purchase a qualifying vehicle, and secured by a first lien on that vehicle. Loans from relatives, pre-2025 loans, or loans used to lease vehicles do not qualify. Additionally, loans for fleets, salvage title vehicles, or vehicles intended for scrap or parts are excluded. Make sure your loan meets all these criteria before planning to claim the deduction. The deduction is subject to income limits. For single filers, the phase-out begins at a MAGI of $100,000 and is completely phased out at $150,000. For married couples filing jointly, the phase-out starts at $200,000 and ends at $250,000. If your income is above these thresholds, your deduction will be reduced by $200 for every $1,000 over the limit. Once your income exceeds the upper threshold, you can no longer claim the deduction. MAGI, or Modified Adjusted Gross Income, is your AGI plus certain deductions or exemptions, such as foreign earned income or housing costs. It's the figure the IRS uses to determine your eligibility for the car loan interest deduction. Make sure to calculate your MAGI accurately, as it directly affects whether you can claim the full deduction, a reduced amount, or none at all. Let's walk through a sample calculation. Suppose you're single, paid $12,000 in qualified car loan interest in 2025, and your MAGI is $120,600. First, the deduction is capped at $10,000, so you start there. Next, your MAGI is $20,600 over the $100,000 threshold. Divide $20,600 by $1,000, rounding up to 21, then multiply by $200, resulting in a $4,200 reduction. Subtract that from $10,000, and your allowable deduction is $5,800. This example highlights the importance of both the interest cap and the income phase-out. Here's a quick reference for the car loan interest deduction. It's available for tax years 2025 through 2028, with a maximum deduction of $10,000 per year. The deduction is below the line, meaning you can claim it with either the standard or itemized deduction. The phase-out range is $100,000 to $150,000 for single filers and $200,000 to $250,000 for joint filers. You'll need to use Schedule 1A to claim it. To claim the car loan interest deduction, complete Schedule 1A and include it with your federal tax return. You'll also need to provide the Vehicle Identification Number, VIN, for the qualifying vehicle. If your vehicle is replaced due to an unforeseen event, such as a lemon law replacement, use the VIN of the replacement vehicle. Make sure you have accurate records of the interest paid, as your lender should provide a statement if you paid at least $600 in interest during the year. For the 2025 tax year, your lender should provide a statement by the 31st of January 2026 showing the total interest paid. This can be a monthly or annual statement, or any document that accurately reports your interest payments. Starting in 2026, lenders must send Form 1098 VLI if you paid at least $600 in qualified interest. These documents are essential for completing your tax return and supporting your deduction if the IRS asks for proof. If you refinance your car loan, you may still be able to deduct interest on the new loan, provided both the original loan and vehicle met all deduction requirements. The new loan must also be secured by a first lien on the same vehicle. Only the interest paid on the outstanding balance as of the refinancing date is deductible. Be sure to keep documentation from both the original and refinanced loans. One of the benefits of the car loan interest deduction is that it's a below-the-line deduction. This means you can claim it whether you take the standard deduction or itemize your deductions. It's reported on Form 1040 below the line for adjusted gross income, making it accessible to more taxpayers. This flexibility is a key advantage of the new deduction. If you inherit a vehicle tied to a qualified loan, you may still be able to claim the deduction, as long as the loan remains secured by a first lien on the vehicle. However, if you simply assume someone else's debt, you typically cannot deduct the interest. Always check the loan documents and consult a tax professional if you're unsure about your specific situation. There's no limit on the purchase price of a qualified vehicle for the car loan interest deduction. The only cap is on the amount of interest you can deduct up to $10,000 per year. This means you can buy any new vehicle that meets the other requirements and still claim the deduction, regardless of how much you paid for it. The deduction is only available to the original owner of a new vehicle. If you purchase a pre-owned or used car, even if it's new to you, you cannot claim the car loan interest deduction. The vehicle must not have been previously registered or titled by the dealer or another owner before your purchase. To verify your vehicle's assembly location, check the window sticker at the dealership or use the National Highway Traffic Safety Administration's VIN decoder online. The assembly point or plant of manufacture must be in the United States for the vehicle to qualify. This step is essential before you claim the deduction. Certain loans are not eligible for the deduction. These include loans from relatives, loans used to lease vehicles, loans for fleets, salvage title vehicles, or vehicles intended for scrap or parts. Only loans used to purchase a single, qualifying new vehicle with a first lien are eligible. Be sure to review your loan documents carefully. If you're married and file separately, each spouse can claim up to $10,000 in car loan interest deduction on their own return, provided they each have a qualifying loan and vehicle. For joint filers, the phase-out range is higher, but the deduction cap remains $10,000 per return. This flexibility can be helpful for couples with multiple qualifying vehicles. If you have more than one qualifying car loan, you can combine the eligible interest from each loan to reach the $10,000 annual deduction limit. However, the total deduction cannot exceed $10,000 per year, regardless of how many vehicles or loans you have. This rule helps prevent abuse while still allowing flexibility for families with multiple new vehicles. If your vehicle is used for both business and personal purposes, you must allocate the interest paid between business and personal use. Only the personal use portion is eligible for the car loan interest deduction. The business use portion may be deductible as a business expense, but not both. Accurate mileage logs and records are essential for proper allocation. Vehicles not built primarily for public roads, such as golf carts, race cars, forklifts, riding lawnmowers, and farm tractors, are not eligible for the deduction. Even if these vehicles are occasionally driven on public roads, the IRS generally excludes them from this tax benefit. Make sure your vehicle is street legal and intended for regular road use. The vehicle must have at least 2 wheels and be treated as a motor vehicle under the Clean Air Act's emission standards. This means it must be self-propelled and designed for transporting people or property on a street or highway. Most new cars, trucks, and motorcycles meet these requirements, but it's good to double-check if you're unsure. Schedule 1A is the form you'll use to claim the car loan interest deduction and other new deductions from the One Big Beautiful Bill. You'll need to report the total, qualified interest paid, the VIN, and any other required information. The total from Schedule 1A is then reported on your Form 1040. Make sure to follow the instructions carefully to avoid errors. Keep all documentation related to your car loan interest payments. This includes monthly or annual statements from your lender, Form 1098, VLI, starting in 2026, and any correspondence about your loan. Good record keeping is essential in case the IRS requests proof of your deduction. Store these documents securely for at least 3 years after filing your return. TurboTax offers a range of support options to help you claim the car loan interest deduction. You can get help from tax experts, use online resources, or access community forums. TurboTax also provides guarantees for accuracy and maximum refund, so you can file with confidence. If you have questions about your specific situation, consider reaching out to a TurboTax expert for personalized advice. TurboTax provides several ways to file your taxes, including having an expert do your taxes, filing with expert help, or filing on your own. Each option offers different levels of support and pricing. You can also compare options to find the best fit for your needs. TurboTax's user-friendly interface and step-by-step guidance make it easy to claim deductions like the car loan interest deduction. TurboTax stands behind its products with several guarantees, including 100% accurate calculations, maximum refund, and audit support. If you pay a penalty or interest due to a TurboTax error, they'll cover the cost. These guarantees provide peace of mind when filing your taxes and claiming deductions like the car loan interest deduction. You can file your taxes and claim the car loan interest deduction using the TurboTax mobile app. The app offers a convenient way to prepare and file your return from anywhere, with features like document upload, step-by-step guidance, and access to expert help. Download the app from the App Store or Google Play to get started. If you prefer to work offline, TurboTax Desktop offers a robust solution for preparing and filing your taxes. The desktop version includes all the features needed to claim the car loan interest deduction, along with guarantees for accuracy and maximum refund. It's a great choice for those who want more control over their tax preparation process. TurboTax offers a range of pricing options depending on the level of support and features you need. From free filing for simple returns to premium services with expert assistance, there's a solution for every taxpayer. Pricing is transparent and you only pay when you file. Check the TurboTax website for the latest offers and discounts. For business owners, TurboTax Expert 365 Business provides year-round tax advisory, bookkeeping, and expert support. This service is designed for sole proprietors and single-member LLCs, offering quarterly reviews, tax planning, and full-service tax preparation. It's a comprehensive solution for managing both business and personal tax needs. TurboTax prioritizes your security with built-in protections for your data and privacy. The platform uses advanced encryption, multi-factor authentication, and regular security audits to keep your information safe. You can file your taxes with confidence, knowing your personal and financial details are protected. If you're ever audited, TurboTax provides audit support, including one-on-one Q&A with a tax professional. While TurboTax won't represent you before the IRS, they'll guide you through the process and help you respond to audit letters. Audit Defense is also available as an add-on for more comprehensive representation. TurboTax offers a refund advance loan based on your anticipated federal refund. If you qualify, you can receive funds quickly, sometimes within minutes after the IRS accepts your return. The loan is repaid from your refund, and there are no fees or interest charges. This can be a helpful option if you need your refund money sooner. With the File Now, Pay Later program, you can file your taxes and pay your federal tax balance over time. This loan is available for balances between $200 and $6,000 with flexible repayment terms. It's a convenient way to manage your tax payments if you owe money to the IRS and need extra time to pay. TurboTax provides a suite of calculators and tools to help you estimate your refund, determine your tax bracket, monitor self-employed expenses, and more. These tools are free to use and can help you plan your finances and maximize your deductions, including the car loan interest deduction. TurboTax offers customer support through live chat, phone, and online help centers. Whether you have questions about the car loan interest deduction or need assistance with your return, support is available 7 days a week during tax season. TurboTax's knowledgeable staff can help resolve issues quickly and efficiently. The TurboTax online community is a valuable resource for getting answers to your tax questions, sharing experiences, and learning from other users. You can browse forums, read articles, and participate in discussions about deductions, credits, and tax law changes. It's a great way to stay informed and get peer support. Stay up to date with the latest tax tips, law changes, and expert advice through the TurboTax blog and Learning Center. These resources offer in-depth guides, videos, and articles on topics like the car loan interest deduction, maximizing your refund, and navigating new tax laws. It's an excellent way to expand your tax knowledge. To wrap up, the car loan interest deduction under the One Big Beautiful Bill offers significant tax savings for those who qualify. Remember to check your vehicle and loan eligibility, keep accurate records, and file the correct forms. TurboTax provides the tools, support, and guarantees to help you claim this deduction with confidence. Stay informed about tax law changes and always consult a professional if you have unique circumstances. Thank you for watching. The new car loan interest deduction is a valuable opportunity for many taxpayers. By understanding the rules and using the right tools, you can maximize your tax benefits and make car ownership more affordable. For more information, visit the TurboTax website or reach out to a tax expert. Wishing you a smooth and successful tax season.